Read you the speech by Waller that was made yesterday for the economic outlook going forward in today's market environment. I'm not going to read all of it. I'm going to start here in the middle. I'm going to skip the introduction. And basically, we're going to start right here. So this is persistently high inflation. Now let's talk about inflation. Yesterday's report on the Consumer Price Index, or CPI, for June was a major league disappointment. On a 12-month basis, total inflation stood at 9.1%, the highest in 40 years. Core, which came down slightly in the last couple months, has averaged over 6% this year and is too high as well. No matter how you look at the data, inflation is far too high, and my job is to move it down towards our 2% goal. Now, we know that supply shortages and bottlenecks, including a tight labor market, have contributed to the high inflation readings we are observing. We also know that the surge in demand during the pandemic that was driven by excess saving, significant fiscal stimulus, and accommodative monetary policy also has contributed to the high inflation we are now experiencing. There is some research estimating how much of this inflation came from supply problems and how much from high demand. The main point is that both played a large part in driving the inflation that we have seen over the past year. But the causes of inflation don't affect my approach to policy, because in writing the FOMC's mandate, Congress did not say your goal is price stability unless inflation is caused by supply shocks, in which case you are off the hook. We want to reduce excessive inflation, whatever the source, in part because, I like how they say whatever the source, in part because whether it comes from supply or demand, high inflation can push up longer run inflation expectations and thus affect spending and pricing decisions in the near term. These decisions can then push up prices even more and make inflation harder to get under control. I pay attention to both surveys of the public's inflation expectations and measures of inflation expectations derived from the trading of inflation-indexed securities. I prefer the latter market-based measures, which are down from recent peaks but still elevated. The board staff combines various surveys and market-based measures in our Index of Common Inflation Expectations, which has moved up slightly in recent months after being flat for a long time. We need to avoid expectations rising so much that they become a factor that drives inflation higher. Now, the path of monetary policy. So, based on persistently high inflation and the very tight labor market that I have described, let's talk about the implications for monetary policy. Since March, the FOMC has raised federal funds rate 3 times for a cumulative 150 basis points. This is the fastest pace of tightening in close to 30 years. At our last meeting, we raised the policy rate by 75 basis points, which is a large move by historical standards. That size increase was not an overreaction to one data point on inflation. It was primarily the response to a sequence of excessively high inflation readings since the beginning of the year. It was appropriate given the lack of progress on inflation and clearly signals the FOMC's commitment to get inflation under control as soon as possible. The response of financial markets to the FOMC's policy actions and communications indicate to me that the committee retains the credibility and the public confidence that is needed to make monetary policy effective. Longer-term interest rates have moved up to levels not far from those reflected in committee members' estimates of the final destination for the federal funds rate in this tightening cycle, effectively implementing policy ahead of time. The average rate for a 30-year conforming fixed-rate home mortgage has increased by more than 2 percentage points since the end of 2021. While there is some slowdown in home sales, lenders and borrowers are still doing business at these rates, which indicates that they believe the FOMC's policy intentions are credible, as broadly reflected in the interest rate paths in the summary of economic projections. As I've said before, with inflation so high, there is a virtue in front-loading tightening so that the policy moves as soon as practical to a setting that restricts demand. Getting there sooner will bolster the public's confidence that we can get inflation down and will preserve options for adjusting the pace of tightening later if needed. With this view, it should not be surprising that looking forward, the FOMC's next meeting, which is July 26th through the 27th, and with the CPI data in hand, I support another 75 basis point increase, bringing the target range for the federal funds rate to 2.25% to 2.5% before August. I judge that level is close to neutral, by which I mean a level that neither stimulates nor restricts demand, assuming the economy is growing moderately at its potential and unemployment is roughly where it is now. However, my base case for July depends on incoming data. We have important data releases on retail sales and housing coming in before the July meeting. If that data come in materially stronger than expected, it would make me lean towards a larger hike at the end of July meeting, to the extent it shows demand is not slowing down fast enough to get inflation down. So, they just told you there's going to be important data releases on retail sales. Mark this down on your calendar. Retail sales and housing. Mark it, because, as he just said, if it comes in materially stronger, you could expect a 1 basis point hike. Now, based on what we know about inflation today, I expect that further increases in the target range will be needed to make monetary policy restrictive, but that will depend on economic data in the coming weeks and months. Between the end of July and the FOMC's September meeting, we will get 2 employment and CPI reports with data for July and August. I will be looking for signs that inflation has started its move down towards our 2% target on a sustained basis. I anticipate a decline in inflation will come as actual and anticipated hikes by the FOMC cool demand for products and labor, which will help demand and supply come into a better balance. The decline in the rate of inflation will also be assisted by continued improvement in goods supply bottlenecks, which is occurring in some sectors, and an increase in labor force participation, which is still significantly lower than it was before the pandemic. I hope these supply recoveries happen, but my expectations for policy don't rely on it. I expect rate increases will continue after July at a pace that is dependent on the incoming data. Now, after the July meeting, further increases will be restricting demand. Looking further in the future, I will need to see how tightening this year is affecting the economy and bringing inflation down towards that 2% target. Based on my forecast for the economy, I expect monetary policy to be restrictive until there has been a sustained reduction in core personal consumption expenditure, or PCE inflation, which excludes food and energy. That is huge. Food and energy excluded from that. Now, food and energy prices tend to be volatile, so focusing on core PCE inflation is a good guide to inflation pressures in the near and medium term. They're also telling you this: F the PCI or the CPI, look at PCE moving forward. Now, importantly, as futures prices for commodities, food, energy, and raw materials have declined recently, I'm expecting total PCE inflation to decline in coming months. But until I see a significant moderation in core prices, I support further rate hikes. In talking about where monetary policy is headed, it is helpful to get a fix on where it is right now. I mentioned the concept of a neutral interest rate, and this belief that the federal funds rate will be close to neutral after another 75 basis point increase at the end of this month. Now, but some would argue that monetary policy is actually further away from neutral, based on the fact that current inflation is so much higher than the federal funds rate. In my view, that rests on a flawed idea of how monetary policy affects spending decisions. That's because spending decisions that require borrowing are based on an outlook that extends several years. This means taking into consideration longer-term real rates, which are tied to the expected path of policy and inflation over the next several years. As a result, I think the estimates of the federal funds rates, the real federal funds rate, should be based on the expected policy rate 1 to 1.5 years in the future. I'm sorry, I should read that again. As a result, I think that estimates of the federal funds rate, the real federal funds rate, should be based on the expected policy rate 1 to 1.5 years in the future. Now, based on trading in inflation index treasury securities of different maturities compared to nominal treasury securities, investors see federal funds rates above expected inflation starting about 6 months from now and steepening thereafter. Primary securities dealers surveyed the New York Fed likewise estimate the real federal funds rate will be a positive 0.7% in mid-2023 and a 1% by mid-2024. This gives me some confidence that tightening now, anticipated by markets and expected by FOMC participants, will be sufficient to reduce demand and inflation. Now, this last section here, evolution of the economy. The FOMC's plan for getting inflation under control depends on a view of the economic outlook. As I've noted in the past speeches, accurate economic forecasting is very hard, especially when unusual factors like a war and unprecedented factors like a pandemic buffet the global economy. FOMC participants record their individual outlooks that are presented every 3 months in the SEP. At our June meeting, the latest SEP shows that there is some expectation among participants for what is often referred to as a soft landing. With a policy path like what I described for this year and a bit more tightening next year, the median SCP respondent projected that total PCE inflation is expected to fall from its current elevated level today to 2.2% in the fourth quarter of 2024. At the same time, the unemployment rate is projected to rise to 3.7% at the end of this year and to 4.1% by the end of 2024, while GDP would grow below its long-run trend for the next 2 years. Of course, we can't be very certain about the path of the economy more than a few months in the future. That is huge. Keep this in your diary, notebook, whatever. They can't. The Fed's telling you they cannot be very certain about the path of the economy more than just a few months or a quarter into the future. But this medium-term view of a soft landing is very plausible. I say this based on the optimistic view I expressed earlier about the strength of the labor market and on my analysis of the relationship between job vacancies and the unemployment rate. In a recent speech, I noted we have a historically high number of job vacancies compared to the number of unemployed people. Some people have argued that past experience indicates we cannot reduce this large number of vacancies without a big increase in the unemployment rate. But I have showed that the past experience actually indicates that a reduction in vacancies can take place without a big loss of employment. And this is the kind of soft landing anticipated by FOMC participants. So while some data measures suggest the chances of recession have increased, I believe it can be avoided. Uncertainty over how the pandemic could affect the economy in the future and global economic risks related to the war in Ukraine are considerable. These factors could make future policy decisions more difficult than they are today. However, for the reasons I have laid out, and considering the evidence on the state of the economy and the outlook, I don't find it difficult to reaffirm my strong conviction that the continued policy tightening will be appropriate to move inflation down toward our 2% target. I think we need to move swiftly and decisively to get inflation falling in a sustained way, and then consider what further tightening will be needed to achieve our dual mandates. So there you have it. That's the outlook of the economy coming straight out of the Fed. Write all those notes down. I'll link this below so you can take a look. But they just told you a lot of secrets and hints of what to be looking at moving forward in the next couple months. Have a good one.